What's the lesson from all these crises? Well, the lesson is that the central banks don't want to learn the lesson. But which policy has actually, empirically, been successful in avoiding this sad story of massive financial and economic carnage and unemployment, dislocation, a lot of people losing their jobs? There are examples. The East Asian economic miracle, and here we're talking about Japan, Taiwan, Korea, and China, was based on a policy to target bank credit for productive purposes. The green box, the good credit creation. And the bad stuff, banks weren't allowed to create credit for speculation or for consumption. It had to be productive. And this was achieved through credit guidance, whereby the central bank monitors bank credit and basically disallows the dangerous stuff. And so people say, oh, that's an intervention in the free markets. Well, but in many countries, you're not allowed to carry a machine gun in the streets without an authorization. That's an intervention in the free market, because there's a dangerous tool there that, things could go wrong if it's mishandled or used by the wrong people. And the same is true with money creation. It's potentially a dangerous tool, as history shows. And so, we need clever intervention of the right kind that prevents this being used to harm the public. And so that's a fairly good justification for this form of intervention in the credit markets. In fact, you can argue if you have intervention in that place, the decision of the creation, allocation of credit, you probably need fewer interventions in the rest of the economy, because that's really the crucial decision. And so we should remember that credit is always allocated, whether a central bank is watching or an authority is watching that it's the right credit allocation or not. There's always a credit allocation decision, because the credit market is not in equilibrium. And that means, credit is always rationed. The short side has power to allocate, and that is the banks. Unfortunately, central banks don't have generally a good track record, and it was really a certain phase in Japan and Korean, Taiwanese and Chinese experience, which lasted for several decades. But in the end, even that system got undermined as the Bank of Japan abused its power and asked the banks to increase bank credit for speculation. So actually it confirms that this credit guidance is very powerful. You can use it for good purposes, but you can also abuse that tool. And so the Bank of Japan created the bubble of the 80s and then implemented the monetary policy of the 90s, which prolonged the recession. We're now in the third decade of recession in Japan and the fourth decade of disastrous central bank policy. So clearly, we've got to watch central banks, and maybe it is risky of giving so much power to central banks, particularly if they're privately owned, such as the Federal Reserve or several other central banks, or basically very, very much aligned with large banking groups and therefore not working in the public interest. So, are there alternatives? Yes, there are. Let's think of a structure of the banking system that would achieve the same result as clever, good credit guidance, but without the need to do much guiding. So let's briefly think about small and medium-sized enterprises. Why should we talk about small companies? Weren't we talking big things here? Well, SMEs are very important. Actually, let me just do this slide first. They're the biggest employer in Sweden, in Japan, in Germany, in the UK, in the US. Small and medium-sized enterprises are the core of the productive economy, and their activity tends to contribute to stable economic growth. They account for usually between 20 and 30% of total investment, but between 60 and 85% of employment. So they are the main employer in most countries in the world. Why is that? Why are they such a big employer? Because they are job multipliers. A fixed amount of money invested in a small firm will create more jobs in the small firm than the same amount of money invested in or by a large firm. And that's due to economies of scale. It's what the economists call efficiency. The big firms are efficient, so they don't need to employ people. But small firms create the jobs. And that's, of course, why they're very important. Now, they are also dependent, small firms are dependent on banks for funding. They don't get access to capital markets. That's for big firms. So the biggest source of funding for these very important parts of the economy, the main employers, are the banks. Now, what about the banks? What types of banks are most prone to lend to the dangerous stuff? Large-scale financial speculators doing the financial speculation that you've seen creates asset bubbles and busts. Well, it's the large banks. It's an empirical fact that the following rule in banking applies. Large banks want to do large deals with large customers. Why? It's efficient. It makes sense, it's rational. You can't blame the bankers. They are being rational, they're being good bankers. But that means that when you have big banks, and when an economy is dominated by a small number of big banks, you will get mainly loans to big companies and not to SMEs. A crucial extreme example is the United Kingdom. There's 5 banks which account for 92% of banking. And they don't lend to small and medium-sized enterprises. The government has tried for many years to get them to lend to SMEs, give them incentives. No, they're not doing it. They're still shrinking their SME lending, and it's probably less than 3% of their total lending. Why? Well, it's so unattractive for them. They're large. I mean, if you're Lloyds Bank, if you're Lloyds Bank and you have a balance sheet of £1,000 billion and you have shareholders that say you need to grow, you want to grow by 5%, so 50 billion is what you need to increase your lending. And you have an option to lend £20,000 to small firms, each £20,000. We need 2.5 million of those loans. There's a lot of work. Too much work for the big bankers. They'd actually have to roll up their sleeves and, forget it. The alternative is much more attractive: to cut 50 checks to hedge funds that borrow £1 billion each. So that's what they're doing. That's what the big banks are doing. They're lending money to the hedge funds, private equity funds, for financial speculation, not for productive purposes. But there are examples of systems where these big banks are not dominant but small, and that is Germany. It's a prime example. So these large banks that are perhaps getting the international headlines, Deutsche Bank, Commerzbank, they're only 13% of banking in Germany. The majority, 70%, is local banks. 2 types: the local savings banks, Sparkassen, 43%, and the local cooperative banks, 27%. And in total, there's 1,700 of these small local banks. So certainly a town like Motala would have one of them, and there'd be several in Linköping. That's the sort of structure. They have been under pressure in the last 20 years from the EU, from bank regulators, so they have merged and their numbers have been declining, which is not good, because the smaller, the better. They tend to go under the same name, Volksbanken, Raiffeisenbanken, Sparkassen, but they're all legally separate companies, banks that make their own decisions locally, and they plow the money back into the local community. So that's really the policy solution. And it's something we can do where we don't have to wait for politicians to act, because just like the banks who want to talk to big companies, politicians also want to talk to big companies and big banks, because they usually need funding and various other reasons. So these sort of changes don't happen top down. Historically, they've only happened bottom up, and that's what we can do. We can act immediately. So the creation of a network of local, small-scale, not-for-profit banks is how we can take the privilege of money creation back to the local level, give it back to the people to who it belongs. That is actually, of course, what banking looked like in most countries 150 years ago, also in the UK. But because banking is lucrative, when banks are up for sale, they will be sold. And so they merge and they become bigger. So banking, like many industries, but is particularly prone to concentration. So the problem nowadays is where we have many big banks dominating economies, centralization of bank operations, the loss of local knowledge, informed local decision making is not happening. There's no relationship banking often anymore. Focus on large-scale borrowers. That means also the unproductive financial speculative lending becomes more important, less job creation, and capital extraction from the regions. Bank branches then largely serve to collect deposits, but then actually money is being lent centrally, so maybe more in Stockholm to the fund industry and the speculators than all over the country. And the consequence is, well, the consequences, that we don't have a thriving local economy as a result. It could be much more thriving. And the banks do not consider the well-being of the local economy when they make their decisions. In the UK just last week, another announcement that Lloyds Bank is going to close another 200 branches because they're not interested in branches and they haven't used them to get to know local businesses. And so all that local knowledge is disappearing. We're now establishing the Hampshire Community Bank in Hampshire, in south of London. And the idea is that's a bank that focuses on local SMEs, micro businesses, social enterprises, lends productively, not for speculation, uses local deposits, so people locally know when they save there, their money is used for local purposes, generating jobs. It supports green projects and can become then an engine for local growth. And we want to make this a pilot, a model that can then be copied and rolled out in the UK, where savings banks were invented a long time ago, but they've disappeared. And we want to set up another new association of such community banks. It's a tried and tested business model. German history shows that it works very well. In the last 170 years, no tax money has ever been used to bail out a German Sparkasse or cooperative bank. Despite that, they're currently being forced to hand over a lot of money to the new European bank bailout fund, because of course the EU has had its eyes on their own internal security mechanism in order to transfer the money probably to Spain and other countries. Yep.
How come? Do you mean that they never go bankrupt, or how come
They haven't gone bankrupt in the sense, yeah, they haven't gone bankrupt. They may occasionally get into difficulties, but that's where the association, the corporation comes in, and they always arrange restructuring measures within the system. So other neighboring cooperative banks or Sparkassen will look at that. Okay, what can we do? How can we help? But at the same time, it's a good peer pressure mechanism, because you don't want to be the head of that savings bank that has to ask the other savings bank for help. And therefore, they are being very cautious. There's peer pressure, they audit each other and so on. So the idea is this would be not for profit, but is very profitable. Unlike the big banks in the UK, which are using offshore structures to minimize their tax payments, the Sparkassen in Germany, 400 now left, they've merged over time, but they're still paying a lot of corporation taxes, 3 billion. And they contribute to community life. In Germany, most of them are organized such that all their profits are returned to the local community. They do a lot of charitable giving. They support sports clubs, cultural activities, theater performance, education, social work, and. It all goes back into the local community. And because, of course, the basis for this is a public privilege, money creation, that's what should happen. The money should go back into the local community. I think I'm probably out of time, but I just want to wind up by reinvigorating local banking and establishing more local banks. We can get a lot of advantages. And even in countries like Germany, where there's still thriving local community banking systems, they have become bigger, and so we have to hold against that, and therefore there should be new creations of new local banks, because the smaller the better. Local banks, and sometimes we get questions, particularly in the UK, are not aiming to compete in a negative sense with other community support developments such as local currencies, or in the UK small-scale credit unions. The idea is to be complementary, and so community banks would work, as we see this actually happening in Germany, quite closely with local authorities, with various local community enhancement schemes, with green and ecological investment schemes. Energy cooperatives are developing. This is a recent development where municipalities are taking the energy supply back to under their own control. They form cooperatives, and of course the local bank can be involved in that very productively. Community currencies, cooperation with local banks we can talk about that, enhance that. And of course monetary reformers are rightly criticizing the current system. This is a way of getting, in a way, a community currency. By having your own bank, you are creating money. And of course supporting also the cooperative movement and enhancing social justice. I think there's lots of advantages.